Okay, welcome everyone. Let's go through some stock charts. I'm just kind of do a stock blitz, kind of go through lots of different charts that I'm looking at. Hopefully there's something you can find in these videos that give you some added value for the trading week ahead. So if you like this content, give me a thumbs up. I do appreciate that. And if you're interested in learning how to use technical analysis to find trade ideas, take my trading course. Link is in the description below. Full disclaimer, I don't always get everything right, but I do get some things right, and I don't get everything wrong either. So let's go through the charts. And at the end of the day, it's not about getting everything right all the time. It's about getting some things right and then managing the things that you get wrong. So risk reward ratio is important. Stop losses are important. Entering trades that have a favorable profitability. All that takes, that's all really key and probably a bigger component to trading than it is just picking winners every single time. It's easy to jump onto a trend and then be right instantly. But if you're looking for the longer term kind of swing trade, which is what this channel is really about, is swing trading, looking for trend trades, then you have to look for what that next trend is typically going to be. So that's what we're going to get into. Let's start off here with the SPY, the SPY. So let's look at the weekly chart since we just ended a week. All right, so here's what we got. The blue line obviously has been my kind of bear market line. That's been my line in the sand really for determining whether I think the market is, in a kind of a topping pattern and going to start a bear market, or whether we're continuing a bull market. So 2009 lows right there. This was the bull trend that I could really spot. We held this on the weekly chart, several reactions. We've got the 2009 lows. We got one reaction there, 2, 3. There's a whole cluster right there, 4, 5. And then we broke in 2018, and we've got reactions from beneath too. So 6, you can see there's another reaction right there, 7. And we're right there, basically right below that trend line, kind of a major area of resistance. So what does that mean? Well, when everyone's looking at a trend line, and I think a lot of people are either looking at this trend line, or I know there's lots of YouTubers that have kind of pointed out something that looks like, I don't know, I think it's something like that. The reason why I don't like that trend line is that there's only 2 data points. You've got 1 data point here, 1 data point here. That's 2. You got to have more than 2 to make a trend. So that is not good. And even if I make something like that, I can't really make out, I still only have 1 data point, 1 data point. This doesn't fit that great. Yeah, we kind of had a reaction there. So that's the point. The reason why I like it is this trend line has 7 reactions on it, and all the rest have 2 or 3, and I'm going to go with the one with 7 reactions. I think that's a higher probability of being accurate. So we're right below it. And what does that mean? Well, I wouldn't want to be taking longs here. I know there's euphoria, and that's how it always is at the top. You have to understand. Everyone feels extremely bullish at when you get topping patterns, when you get huge moves to the upside, everyone just gets on board and feels bullish. Basically, the way it works is everyone's the most bullish at the tops and everyone's the most bearish at the bottoms. And that's just reality, whether we're going to continue going higher or not, and whether we're at the top, nobody really knows. But do understand that everyone is the most bullish at the top and the most bearish at the bottom. And just take a look. We can take a look at the put call ratio just to kind of point that out. So if you go to the hold on one second. Move that. If you go to just Google put call ratio chart, and you'll come up with this this chart here that shows the put call ratio, and you can see in the year to date, basically, you can see that we've basically in January of this year we've reached pretty extreme lows, about as extreme as it gets on the low side. So what that means is that there's extreme call buying and very low put buying. Down here, basically January 7th, just 2 days ago, we saw, really the lowest put buying that we've seen in, over a year, basically. And that oftentimes means that there's extreme bullish sentiment, all right? So no one's buying put protection. at least back here, and everyone's buying calls. And again, like I said, you usually see the extreme bullishness at the tops. We're starting to see a slight uptick in put buying, so there's some people starting to buy protection. And you would expect to see that when the smart money thinks the rally's about over, they're going to be the first to start to step in and buy put protection. So just understand that. That's really going back year to date. If we go and look at the last year, you know, it's a little harder to kind of pick out the lows because there's so much data. But you can see, you know, we hit 37 here December 17th. And if you look at, you know, there's December 17th right there. That was kind of a near-term high. That was followed by a drop of, you know, 2.5% on the SPY. Nothing crazy. So it's not going to, you know, this isn't telling me necessarily that we're in for a huge crash. I can't get that from this. All I can see is that there's extreme optimism, extreme call buying in the market. And then you got to use your charts to give you some more information. So moving on, the SPY basically, if you see here on the hourly, well, going back to the weekly, what I see is this channel. We've got this channel. If I move my lines down a little bit, but basically we closed at the top of the channel on the weekly. So the weekly has never really broken down out of this channel. If I look at the daily, we obviously had a breakdown right here intraday, but on the weekly chart, we closed the week back above that support line. So I think we're still in the channel, and we obviously have major resistance just overhead. So what I could see this thing doing is kind of just grinding higher a little bit, or we could just fail right here. I mean, there's three scenarios, and it's I guess the way, these are the three possible scenarios basically. One, everybody's looking at this level, so you overshoot it. All right, we have extreme optimism. We just ramp through it a little bit, have some sort of complete parabolic blow off top, and then that's it. That's the end of the bull market. If you see that, that's probably the end of the bull market. That's one option. Another option is we never get to this trend line. Everyone's looking at it. Everyone's thinking we're, you know, going to break. We never get there, and we just sell off impulsively. We're so close now. I don't have strong conviction either way, so I'm just kind of trying to outline these options. Another possibility is we just kind of grind around, and we could run up and just tag it perfectly, and then you know, either break or sell. But usually, if you're so close, you're either not going to get there or you're going to overshoot it. Those are the higher probabilities. One thing is, looking on the weekly, we still have negative divergence, and this negative, I mean, again, when we're looking at the weekly charts, negative divergence can build for years, basically. So it's not an indicator of, oh, get short because we have negative divergence. All it's pointing out is that the momentum we're losing momentum over the period of this chart. Given that this is a weekly chart, this is several years worth of time. So not anything that you can trade off of, but just note that longer term, you know, this is there. And when I talk about a bear market, I'm not talking about a 1 or 2 month bear market. I'm talking about many years. You know, if there's going to be a bear market, I'd expect it to be many years. Could be, you know, we don't know. Could be a decade. Nobody really knows. So that's why it's important to understand the longer term implications of this negative divergence. Could mean a multi-year bear market, and there's the potential to make a lot of profit in that bear market. So, you know, a lot of the time there's more money to be made in a bear market than in a bull market because it's always such a lopsided position. You know, when you're bearish and you're short, you're always the minority. It's just the way it is. The majority is always bullish. So when you see or get a bear market, they're very impulsive. And a lot of money comes out and goes to the minority in terms of positioning. Okay, enough on that. That's the SPY chart. That's where we're at. So we're just kind of hanging out there. We got to wait to see what happens. Let's look at tech. So tech has a different look on the weekly chart. You know, there's your bull market in tech, and I kind of marked out this price channel. Lots of support along the support line. Broke it twice, but again, the Fed basically manipulated it higher. That's basically what these two breaks were. The market wanted to break it, and then the Fed saved it both times. And now we're above it. So this is a low probability area that this price action is going to continue over the long term. I'm not saying it can't just ramp higher in a short period of time. That's completely possible. But over the longer term, since we're looking at a weekly chart, this is a low probability area. And I think since we've been up here for a while, if we get some selling, it's going to be impulsive, and it's likely going to do the trick for breaking this support line. The Fed's kind of out of bullets at this point. They don't have interest rates. They have their balance sheet. That's infinite. They can just go crazy with that. And they might. And so what we'll do is, we'll position for that. If this breaks, if or when it breaks, basically, and we see what the Fed does, they're likely to do something. If they go extreme, even more extreme than they've already gone, to the point where it's just obscene, then I think that maybe we'll position in the gold mining stocks, because they're going to destroy the dollar, and so we'll get the returns we're looking for in the gold mining stocks if we don't get it in a bear market. But as of right now, I think we'll still kind of watch this. Let's zoom in on this one. Here's the daily. You can see on the daily, they broke it down and closed it. Close enough. It's basically at resistance. They popped it marginally above right there. And that was in the last hour of the day on a Friday. So again, that's too close to call. That could be resistance of this trend line right here. This is a daily trend line. Could be resistance, or could have been a false breakout and this wants to ramp higher. Next week we'll find out. How am I playing it? Well, a couple ways. One is I'm moderately short the triple Qs. I have a starting short position, and I took that short position on this breakdown candle. So far, that's not working, obviously, in my favor. It's gone against me. But again, that's why I take a starting short position. So it's not a full short. Let's say you're let's say you normally take, $20,000 on an index short like triple Qs or whatever your amount is. Well, a starting short might be 5,000. All right, so you take 5,000, and then when things start working and you see further developments that your trade is constructive, you can add to that. And that's what I'm basically doing. So I've got a starter short. As of right now, I'm questioning it. We'll see. This was, this is not fully negated yet, this breakdown candle. We didn't see follow through as much, and we're obviously ramping higher. So it's not looking like it's in my favor. I'll stop out next week if if this wants to break higher. And again, stop out for small losses, and it's also key when you're shorting to get your entry. You got to be sharp. I mean, you got to be quick on the trigger to get these things. So, when you have a breakdown right here, I took the short basically on the breakdown candle right there. So from here to there, I'm down 1.8% on a starting short position. It's worth the risk. The risk reward was favorable, so it's worth the trade. All right, so looking at the hourly on this guy, you can see here on the hourly a little bit of a different picture. We've got this, bearish rising wedge, breakdown candle, and a back test. So you can't definitively say that this is not a back test and we're about to roll over, because it hasn't really recovered that on the hourly. It is still a valid, valid trade. However, if it breaks above and this proves to be a false breakdown, then sure, then we could say that it's not a back test anymore. So we're just looking for that. We've got negative divergences pretty much across the board, but especially on this daily here. This daily chart is a little bit more of a tighter time frame for swing trading. Weekly can go years, and we can't use the weekly divergences to get us into swing positions. The daily is a better time frame, so I prefer the daily to find negative divergences, and then I look for the hourly breakdowns. And negative divergence there, that's not been negated or burned through, so that's still there. All right, IWM. So this one, if you look at the daily, we do have negative divergence. It's right there. See how we have breakdowns. I know a lot of people say negative divergences don't work. They do work, typically. They don't always work. I mean, they work a lot, but nothing's guaranteed. So they don't just play out instantly. When you get negative divergence, it's not like, oh, negative divergence, everything's crashing. That's not how it works. typically it shows up telling you, okay, we're likely to, we can make some marginal new highs and build on the divergence, but it's likely going to play out for a bigger trend reversal, and it's going to wipe out all those gains. That's what the negative divergence tells you. And it's not a reason to necessarily short. You want to look at the charts. You want to look for trends and breaks of trendline support. All right. So this is all in my course, and I go through a lot of that. So when I go through these videos and say, oh, we have negative divergence, I'm not saying get short. This is the time to get short. I'm trying to just, cue everybody in that, okay, this is weakening. This trend is weakening. Let's look for cracks in the armor. And then take action when we see a trigger, a trade trigger. And so IWM, we had a break. Here's your trend line support, your bearish rising wedge right there on the daily chart. We broke, we did a back test, and as you zoom in, and if I go to the hourly, you can see we broke above, but it still failed and closed the week below. All right, right at resistance pretty much. So too close to call. But at the same time, we're below resistance. Resistance has still held, and this trade and chart pattern is still valid. So this could be a back test. We could roll over. So look for that. And you look at the hourly, we've got bearish PPO crossover. It ramped way up, and towards the end of the week, it turned down. So I know everything seems bullish, but typically the best entries for short positions are at the moment when everything seems the most bullish. Okay, obviously I've been talking about the bonds, the long bonds. Everybody on YouTube's talking about it at this point. So it's pretty obvious. So who knows how this is going to play out, because it's pretty obvious. But we'll look at the daily here. The long bond cracked, basically. And what that means is institutional money is selling the long bond. Are they, to me, I read that as the market seeing inflation's coming. But I'm getting conflicting signals because gold had such a big sell-off on Friday. So we need to see some follow-through. This is just a couple days. Let's see what kind of follow-through, whether I suspect we'll probably get a bid in the long bond. Maybe it bounces. And then if it's going to reject and continue trending down, look for it to reject at the next point of resistance, which is likely, right about this 154, 155 area, somewhere right in there. It should reject if the long bond is going to continue lower and the market continues to see inflation. If it breaks above, this was a bear trap, and the long bond's likely going higher and going to break out to the upside, and the market's going to likely sell off. There is the possibility, obviously, for the long bond and for bonds to sell off with equities, and that's kind of the doomsday scenario where bonds are selling and equities are selling. It's always possible, but it's kind of an outlier in terms of probabilities. But it does happen on occasion, so we'll keep an open eye for that as well. The long bond has support. The nearest support I see is all the way down here around this 149, 150, or 148, depending on when it actually gets there. That's kind of this downward trend that it's been in. This is downtrending, so down there is support, and there is no bullish divergence anymore on the daily chart for this. So that is in general, when you have divergence, bullish divergence, and then you burn through it, that's bearish. That's pretty bearish. So we had bullish divergence right there. You can see how it was building, and we kept making new lows, kept making, slightly new lows. Now it broke and made a new low. So no longer bullish divergence on that one. What does that mean? Well, rates are going up. And that's what that means. So if this is going to continue lower, I'm not long this thing. I don't want to be long this thing. I'm not interested in this, but we can use this and see if rates continue to rise. That's going to start to put pressure on markets. All right, gold. I pointed out gold. It broke this kind of slight uptrend, but I also pointed out this was your point of support. I said, we fell right to here, and we were likely to find some support here. So I don't know if this level is going to hold. If it does hold, then this is just a back test of this breakout right here. This was a breakout above this downtrend line, back test, and then maybe we're off to the races. Again, gold is in a bull market, so here's your bull market in gold, higher highs, higher lows. And we had this kind of consolidation bear flag action right here. If we're going to break, then we're likely to see another impulsive move to the upside. That's what I think is going to happen. But again, there is the possibility that this is that we're going to break down some more. And if we do break down some more, I think around the 1700 to 1750 area, somewhere in that zone, is probably the best buying opportunity you're going to get in gold for probably for a few years. So I will be buying down there for sure if it gets down there, and I'll be using the gold miners for positions in gold. Okay, the dollar. This one has the video I put out on Friday was stock market crash, wrecking ball. All I'm trying to say when I say stock market crash, yeah, I'm trying to get clicks, fine. But at the same time, I am trying to point out the potential for a trade. I don't want to point out the obvious of, hey guys, market's in an uptrend, trend is your friend, buy stocks. Okay, that's fine. But I'm trying to say, okay, this is what might happen next. So because here's the signs that I'm seeing, so keep an eye on it. I'm trying to skate to where the puck's going to be, not to where the puck is. I don't always get that right, but again, that's, I'm going to continue trying to do that. Here's the dollar breaking out. Here's your downward trend right there in the dollar. All right. So the dollar's been falling pretty much all of 2020 after COVID and the Fed. The dollar's been falling and the market's been rallying. Everything's been rallying, but everything has been rallying on the dollar weakness. That's what it is. That's why commodities are up. That's why, commodities are rising because the dollar's losing value for the most part. I know a lot of people think that there's supply disruptions. If you've taken economics, you've got the supply curve and the demand curve. And when you have a supply curve shift where you have less supply, then prices go up given equal demand, essentially, or increased demand. Now, I think we don't have increased demand. I think ultimately we have less demand. And yeah, there's potential for supply reductions. But I think for the most part, to me, this looks like more like a dollar play where we've got the falling dollar. Because the thing is, you can see the dollar right there. The dollar's lost 10%, 15% in value. And everything that's priced in dollars has gone up. And emerging markets have been doing well as also. And emerging markets going up is not a play on supply of commodity products falling. It's a play on the dollar, the US dollar falling. Okay, so going back to the dollar, here's a breakout of this downtrend line. Let's go to the hourly here. Well, actually, before I get off this daily, bullish divergence right there. Boom. All right, and there's a bigger bullish divergence right here. That's a bullish divergence, but this one's a little bit more steep. It's a little more obvious where we have a lower, we kind of have this low right in here, and then you continue to make slightly new lower prices while momentum's moving up. So the dollar at this point has reversed. We have a breakout of this falling trend line here. We have bullish divergence signaling a trend reversal is likely, and there's your trend reversal. Now it's only, it's early, so we need to see continuation. And the way I'm not playing the dollar. I'm not looking to play the dollar. I'm looking to play, I'm looking to play the markets differently. So like a dollar rising is likely going to be very bearish for a stock market that's been rising on a falling dollar. So dollar up, market's down, dollar down, market's up. I think that correlation's intact. Okay, the miners, and then we'll get into some other stocks. The miners, Barrick Gold here, had a sell-off on Friday, but not too bad of damage. You can see we're just in this kind of cluster zone here, and all the technical patterns are still intact. You've got bullish divergence on the daily chart in Barrick Gold. They're not in all the miners, but it is in this one. And this is a major miner, so I think, if you're going to use any miner as kind of a gauge in terms of where the other miners might go, the larger miners are probably going to give you that read, that general read, before maybe some of the smaller miners do. Bullish divergence and just holding up here. So again, when we had bullish divergence, I was buying along this support line. This was major support down here at 2250. That came back from all the way here. You can see we had held support right here in June. It held as resistance back in February. I think it rolls all the way back. Pretty much this entire bear market pattern. This was kind of a major resistance point. So we broke above that at this point, and we had a couple whipsaws below, but it's held. and we've got bullish divergence. So to me, I think the miners, this looks like it's going higher. Yes, we obviously could go lower, and this has the potential to maybe go down to this $17, $18, $20 range. There is a trend line. It's not the cleanest, but it's the best I can make, which could be the bull market trend line for Barrick. And so, yeah, we could go down there. And if we do, that's probably the best opportunity you're going to get to buy this thing in many years. Okay, XLV, I bailed from this one. This one just wasn't working for me. And let's see, I got short on this thing on this breakdown right here. And it just hasn't gone down. It's just been kind of grinding higher. It's just kind of dead money for me. So took a loss on that one of, I didn't bail it on Friday. I think I took it out on Wednesday. So it was about a 3% loss on that. Wasn't a huge position. And, just trying to, find things that are working. But technically it burned through this bearish divergence right here. And so I don't have a reason to be in it anymore. So I'm out of that one. Small loss. Here's your financials. XLF. This one still looks good. I'm still bearish on this basically, but I'm not bearish from down here. All right, this has obviously been going up. I'm bearish from up here. Up in this area. This is where I get bearish. All right. So when everyone understands when I say I'm bearish, it's all about timing, right? It's all about when you get into the market long or when you get into the short. And just like bulls, a lot of the time will just dollar cost average. They're just eternally bullish and they just buy no matter what. Well, it's okay, like you can do that from the short side as well. If you're bearish and the chart's still constructive and still looks good, then you can add. I prefer to kind of add when a trade starts working versus when it goes against me. But sometimes I will. It just depends on what the chart looks like and, how things are starting to kind of line up. I haven't added to this one. I mean, I'm not bearish XLF, I'm bearish Citi. But let's point out this one. You got this gap right here at 30. We do have this trend line coming back off the 2011 lows. So this is kind of your bull market trend line in XLF. We broke, this is your COVID drop, and they have recovered it. So that's, in general, that's bullish. This is a breakout right here. There's nothing, I can't shake that. So, and again, if you see the daily, it looks like they did burn through that negative divergence as well. So in short, it's not bearish at this moment, this indice. Let's look at Citi here and see what this thing looks like. So Citi has a different picture though. XLF is obviously a kind of, it's banks. I think there's insurance companies in there. That's kind of the index, but Citi still has negative divergence. Citi here, and again, I got bearish right in here. So yes, down a little bit, but still, I wasn't bearish down here. I wasn't, bearish all the way here. I'm bearish right up here. So it's against me a little bit, but we still have time in our favor, I think. Negative divergence on the daily. That's a clean, clear negative divergence. Let's look at the PPO. Yeah, we got a little bullish crossover right there. So we'll see what that means, whether we want to extend this divergence or burn through it. Nobody really knows. We also have what to me looks like a downtrend line coming off the 2011 lows right here. And we have broken out above it. So here's what I'm looking for on this. The pattern looks like it's going to be an island top reversal. Doesn't mean we don't have the reversal yet, but we got the gap up. And now I'm looking for a gap down to signal the island cluster top reversal, similar to what we saw kind of right in here. All right, that's what this looks like it's going to turn out to be. Until it does, this thing's bullish price-wise, but bearish technically. So bearish technical posture, bullish price action, looking for that reversal. So if you get the island cluster top reversal, that would be a sell signal as well. Okay, this one, apps, Digital Turbine. I'm looking for a short here. There's no entry, there's no trigger here, there's no reason to short it yet. If you're long, you can stay long, but it looks like we're going to get a sell signal soon, and that's what I'm looking for. So nice clean uptrend line in this off the March lows, and we've got, we basically are just continuing to work our way up that trend line. Big negative divergence on the daily chart right there, telling me that we're going to get a trend reversal. So do we get a nice clean break where we get a good entry to short this thing, or does it gap down? Nobody knows, but I think a sell signal is coming soon. I can't short it until I get that sell signal though. Here's FedEx. This was a short that I pointed out right here when we had the breakdown. So if you took this short like I did, then it's pretty much gone straight down and to almost 20%, 18.5%. And 18.5%, if you understand how the math works, is more than an 18% gain. So you have to have a lot more. This was a drop basically of, on this one, 65, about $65 to equal a 65% gain. You need about right there, about a 32% gain. All right, so this drop is equivalent to a 32% gain. So that's how shorting works. I know when I say 10% drop, it seems like, well, this stock's gone up 100%. Do the math, and you don't, percentage-wise, you don't drop as much percentage-wise, but money-wise, it can be a lot. This one's pretty oversold. Look at the daily down here on this RSI, 22. Really oversold. Now that doesn't mean it can't become more oversold or remain oversold, but I would not be, this is not the time to be shorting FedEx. All right, this is the time to be looking for bounces, or so I think it's likely we get some sort of a bounce, maybe up to here. Who knows where the bounce is going to be? I think it's very likely, but and then look for that bounce to fail and come down to about 183, and that's probably the final target on that one. Tesla, this is a rocket ship. I am short this. Obviously, I'm underwater on it. I just shorted it not too long ago. This is a bubble. It's a clear bubble, and nobody knows when a bubble is going to end. So I want to point that out. Shorting it is very high risk. However, if you have emotional constitution and you have financial staying power, then I think this will be a profitable short. And so that's how I'm treating it at this point. And again, I don't take huge positions in crazy bubble stocks. So position sizing is important relative to your portfolio size and also to the stock. You want to adjust your size appropriate for the volatility. But this stock's crazy volatile. It's just going parabolic straight up, and I'm expecting it to go parabolic straight down once this momentum dies. We don't know when it's going to be. This thing could be up 20% on Monday. So the way I'm treating this is, as it goes up, I'm giving it a couple days. As it goes up, I'm adding like one share over a couple days, and I'm going to continue to do that till I get to an appropriate position size. But I'm going to let I'm giving it time as it's ramping higher. I don't think there's going to be just an objective short opportunity on this. There's so much momentum that by the time the momentum starts to come out, it's going to either be a huge gap down or such a fast move that it's going to be hard to catch to get an objective area to short. So I've got to step in a little bit early on it. And again, I'm not loading up right here short. I don't know if this is the top. It's hard to say. I can't tell. We do have negative divergence that's been building on the daily. And we have this trend line from the March lows, which is really the momentum, the major momentum. Looks like it's coming in for a full back test of that trend line. So that's going to be up around, if I can get the number, maybe up around $950, $1,000. And so again, I'm giving it, every couple days as it continues to ramp higher, 10% per day. I'm just kind of averaging into this short position and moderately. All right, I'm not going to take a huge short position on this regardless. You don't need a big position in order to make a lot of money. If this thing comes crashing down, you don't need a huge position to make a lot of money. There's too much risk. You'll blow your account if you go too big on this thing, especially short, because you're going counter trend. Pointing out NIO, it's doing the same thing as Tesla. So NIO's fate lies with Tesla, and I don't see any different fate. Negative divergence here on the daily. You've got this uptrend line that has not been broken, so there's no ultimate sell signals, and so NIO's fate is the same as Tesla's, I believe. I think they'll perform together. And same with all the other EV stocks. They're all in a bubble. Here's Zillow, March uptrend. You know, here's your uptrend line, broke trend, backtest 1, backtest 2 and 3. Those are objective areas to add to a short position. And we're, you know, and then you can see here we got a topping doji candle there on Friday. So that's a shooting star doji or a spinning top. You know, it doesn't really matter what you call the doji or what it is. All it means, it's a doji, all right? It just means potential reversal candle. I don't really care what the doji's called. Potential reversal candle, look for confirmation. So confirmation would come in the form of another sell-off, probably on Monday. So if Monday is lower prices, then that's your confirmation, and then we look for a trend reversal. So I like that one short right now. Qualcomm. All right, someone has mentioned they're in this still, and I told everyone in the video I was getting out. So I shorted this thing after earnings right here. This was my short entry. And again, shorting, it's key to have clean entries where you're really close to risk, because shorting inherently is already risky. You're fighting the mainstream. You're fighting everything essentially. And so you're always the minority. And so it's very important to have very good entries when you're shorting, keeping your trades close to risk. Because again, like I mentioned, stocks go up 8 out of 10 days for the most part. So you're going to be wrong. When you're shorting, you're going to be wrong more often than when you're right. So you might be wrong 6 trades out of 4, but the 4 trades that you're right will be way more profitable than those 6 losers. That's kind of how it works. So it's kind of inverse thinking. And so here was risk. We gapped up after earnings. That was resistance. Took a short there. I added to the short right there, and I added to the short right there. Why did I add right there? Well, that was backtest of the resistance. So as it backtested, I added and I added. And so that's the key. Take a partial short position, add a little bit till you kind of get to your full risk tolerance, full position size. No position should ever be like 50% of your portfolio. So again, just understand when I say full position size, I'm talking about kind of a trade. I trade in units. Each trade is kind of a unit. When I have a unit, that's a full position size. All right, then it broke and it sold off all the way down here, and I covered my trade right there on the break. I saw that it was coming right down into support. They started to step in a little early. I covered. All right, so I was profitable on every single entry point on this one break. That was that trade. And I'm going back to that. I mentioned it hadn't broken this uptrend line right here. So I don't want to remain short thinking we're going to break. I want to wait for the break, which is the next sell signal. Until then, you can short at resistance or wait for the break of the trend line support. Intel, I'm out of this one. It's in this chop zone area. So just looking at the weekly, bull market from 2009, you're running up in the price channel. We broke, backtested, broke, or sorry, not backtested, but broke, recovered, chop zone. So again, I don't want to be in a chop zone. I'm going to let this thing figure out what it wants to do definitively before maybe taking a position. And there's other opportunities elsewhere, so I can just let this thing kind of do its thing and wash people out. This had bullish divergence as well on the daily. So right there, this was a divergent low. You can see we made a low here, a higher low right there. Divergent low signaling a trend change or uptrend was likely. And so far, that's what it's been. Is from that point has been an uptrend. Moving on, Carvana. Carvana closed right at resistance. So this one, bearish rising wedge. See the wedge right there? We've got, we've continued to work our way within the wedge. Overshot it a little bit, failed, came back in for a back test. I think we go down to the bottom of the wedge. Likely break at some point. Big negative divergence here on the daily. See that? So telling me that this is kind of a topping pattern, which is a bearish rising wedge. Those are topping patterns. You look for the breakdown and ultimately the break of this trend line support. A nice clean red breakdown. I think that's in the cards for this thing in the near future. DraftKings, I talked about this one, let everyone know I was getting out of it. It's just been sideways dead money. We had this big drop right here. I was up about 10% on the trade. And because it's been sideways money and just it was at support, being up 10% in a short position. I covered that short, and just I'm looking at other areas. It just wasn't interesting enough on this one. NVIDIA, I covered this on this big drop right here. The reason why is I was slightly profitable, not by much, but it's also been just kind of sideways dead money. So I'm going to look for probably a break of this line, 475, a definitive sell signal, and for the next kind of trend down. Until we get that, it's just sideways dead money. Peloton, I like this one short still. Here's your March lows, nice clean uptrend line. We broke right here, but we didn't have negative divergence on the daily chart when we broke. So when it ramped up and it came in for a full back test, it put in negative divergence right there on this back test. So this is where I got short. All right. Again, it's all about your entry and your positioning. So this is the short position, short entry right now. And I think as of right now, let's see, it's about break even basically, because they're kind of doing a little back test. So they could run up and do a full back test up to this 173, 174, completely acceptable within the parameters of this short trade. But again, I'm looking for this to reject and break down and head much lower. Ultimately, you know, I think 79, 80 bucks is probably going to be some support for this, and that would be a drop of, you know, from right here of a drop of about 50%. So that would be a double, and that's what I'm looking for on that one. Walmart is maybe an interesting short. It's not my favorite, but here's the thing. If you look at the weekly on Walmart, you've got this bullish rising wedge right here. And this is a big pattern going back to 2015. So big bullish rising wedge, lots of reactions along the top of this trend line. And then we overshot it. So again, this is usually when you see the breakout like this out of a not a bullish rising, a bearish rising wedge. This is a bearish pattern. Usually when you see the breakout to the upside, that's a blow off top move. Where you break out to the upside of a bearish pattern. And then usually these fail and reject and break down all the way down through the bearish rising wedge. And you get the move that this bearish rising wedge was forecasting. So that's the weekly. You can see lots of reactions along this resistance. It's pretty verified. We go to the daily here. We've got this uptrend line that I've been able to make right there. We've got reaction low right there. See the bottom of the wick right there at 102. Reaction there, and kind of a reaction there. So 4 reactions makes for a trend. That's a good trend. We broke, and we've been just kind of back testing a little bit. This, to me, looks like it's actually going to break down. If it breaks down, we're heading down to likely this 130 area, and we'll probably get a reaction right around there. And then look for, you know, maybe there's kind of lots of, you know, consolidation around there, and then look for the bearish break. That's what I'd be looking for. So yeah, it is a sell signal right there, and you know it's not far off from it. Maybe you want to wait for the rest of the market to start to show breakdowns, but again, that does look like a sell signal to me. It's not that impulsive of a breakdown. That's the one thing I don't like about it. But again, if you look at the daily chart, we've got negative divergence right there. There's your negative divergence. We've made a new marginal high while putting in lower highs on the momentum. So yeah, in general, this looks bearish. Just depends on when you actually get the definitive break. And without having those sell signals like in the SPY and the Qs, I'd prefer to just probably wait for those signals to show up before taking a short in this one. First Solar, I talked about this one. This one's been a nightmare to trade, and I just have not traded it. I tried trading it once. It gave me a fault. There was a breakdown here. It gave me a recover. That was a false breakdown bear trap. And so it's done it several times. There's another bear trap, another bear trap, another bear trap. So forget this one. I'm looking for other ones, but obviously still uptrending. It's kind of a mania stock. Here's Sunrun. Nice clean uptrend from the March lows, walking up, you know, broke out. We broke down right there. We had negative divergence right here. Really, it actually started to show up all through here. This was all divergent highs. We broke down, back test 1, you know, kind of a back test 2, and ramping impulsively, kind of a blow off top is what this looks like for another back test. So pretty objective short area up around this 101, you know, 101, 102, somewhere right in there. That looks like a pretty objective short. Still have that negative divergence as well. So if it, you know, This is a divergent high, basically. We've broken over the previous high. We have negative divergence. It's pretty objective. You know, if we can get a little bit higher up to that 101, 100, somewhere right in there, I'm probably going to start taking a starting short position on this one. Okay, and wrapping it up, long video. I know I had a lot of stocks to go through, and I really tried to get a little bit more in detail around some of these, and also just the concepts of shorting and why I'm short. And I know it seems crazy to be looking for a short in such a bullish market, but again, it's you know, it's contrarian. I mean, that is the style, and basically, you know, I want to be I want to be bearish when everyone else is bullish, you know, and especially max bullish. When you're seeing the euphoria and enthusiasm that we're seeing in the market, I want to start to get bearish. And it's the same concept as buying low and selling high. I want to sell high and buy low when shorting. So that is why I'm looking at lots of shorts. I explained my SPY chart and why I think it's bearish. And so watch Apple. You know, to wrap it up, we'll look at Apple. Watch Apple. Big negative divergence here on the daily chart right there. Apple and Tesla. Those are key to watch right now. Tesla is a major player in the SPY now, the S&P 500. I think they're like the 6th largest company. And their market cap was just obscene. It makes no sense, obviously. But, and so they're weighted in the SPY. So if Tesla does start to sell off hard, the SPY is going to sell off pretty good as well, because it's going to drag down the SPY, and the SPY has to sell everything that's in the SPY. So good companies are going to get dragged down with the bad. And watch Apple. So here's your trend line right there off the March lows. We broke it once, they recovered it, and so again, look for another break. It's not, we haven't broken down yet, but we do have negative divergence on the daily, telling me that a break is likely, and likely soon. So the things I'm watching: Apple, Tesla, the dollar, and the long bond. Those are my parameters right now that are giving me kind of a read on the market. And I'm going to continue to watch those to see where we go from here. Thanks, everyone. If you're with me this long, if you stayed for the whole video, I do appreciate it. And I'll catch you guys on the next one.